Position sizing is a crucial aspect of Forex trading because it plays a significant role in managing risk, optimizing returns, and maintaining consistent performance. One of the primary reasons for employing position sizing is risk management. It enables traders to control the amount of money at risk on each trade by setting a specific percentage of their trading account as the maximum allowable risk per trade, such as 1 to 2%. This approach helps protect their capital from substantial losses, even during periods of consecutive losses. Consistency is another key benefit of position sizing. By ensuring that the impact of each trade on the overall account is uniform, traders can maintain steady growth and avoid large losses that might otherwise erase profits accumulated from previous trades. This consistency is essential for sustaining long-term success. Moreover, proper position sizing contributes to psychological comfort. When traders know that only a small, manageable portion of their account is at risk on any given trade, it reduces stress and helps in avoiding emotional decision-making. This psychological advantage supports adherence to a trading strategy and discourages impulsive actions. Position sizing also allows traders to adapt to varying market conditions. In highly volatile markets, traders might reduce their position size to minimize risk, while in more stable conditions, they can adjust their position size to align with their trading strategy. This adaptability ensures that exposure is appropriate for the prevailing market environment. Finally, by optimizing position size, traders can maximize returns while keeping risk within acceptable levels. Proper position sizing helps traders to achieve the best possible outcomes.